it's $3 million or whatever you guys think, whatever the values are, when that purchase happens of those shares, you now have a cost basis because the entity just purchased those shares for whatever that value. So
What's a cost basis?
It solves a lot of issues for the entity at that portion when that happens. But that's what you're going to want to do. That's how you're going to want to set this up.
Okay.
Is the corporation is going to want to own that policy, and it's going to want to own the policy on all the other minor shareholders too, in whatever percentage. So Zach, if you own it at 25%, it's going to want to own a policy on you for 25%.
Yeah, and we want that.
Everybody else around the table is going to want to own a policy on everybody around the table at that percentage. And again, that gets to our second point that Eric just mentioned. You can do the same funding vehicle. We can set up a retirement type vehicle for each person around the table. Now the entity can pay for it. You guys can bonus out some type of structure, and I can show you guys some examples of what this might look like. But you can fund this type of contract and use it for values, and then down the road take those values out during retirement. And it would look something. So I ran one. I've got one up that I run on a client. This is I ran it at $6,000 a year, which is $6,500 is what a Roth IRA is. I'll show you a much bigger policy. Brett, can you make it so I can share my screen?
Yep. Give me 2 seconds.
Now, what's a cost basis? What's that?
So cost basis, so it's really, let's talk about it in real estate, because I know you guys own real estate, so it's much easier for talking about it in those purposes. So when you purchase a piece of real estate and you turn around and sell that real estate, the IRS looks at that and says, hey, you're going to pay tax between the difference of what you purchased that piece of real estate and what you sell it for. The difference in between those two pieces is what's taxable.
Yeah, we just ran into that. We just ran into that. Yeah.
Right. So when you buy a house at $100,000 and you sell it at $200,000, the IRS says you have now a capital gain of $100,000 because your cost basis was $100,000. You have a $100,000 gain because you sold it at $200,000.
Yep.
That's your capital gain.
Right.
In a business of this nature, you have the same issues. You guys have shares of stock of a privately held corporation, and trying to figure out what the cost basis of that entity is very difficult at sometimes. You can hire companies that will come in and give you a valuation. Sometimes that can be costly, but it may be worthwhile. Eric, for you, you may at some point sell the company. Zach, you guys may want to do that. If you have to buy him out at some point, these types of policies can be structured to do a buyout, and we can talk about that at some point. If you guys ever want to do those things, it may make sense. They can be used to do those things as well, but it also can provide a cost basis. When one of the partners dies, because the insurance policy goes into the corporation, that corporation turns and buys the shares, it provides a cost basis. So in my example, if it was $3 million and it buys his 50% majority out, and I'm just using a nice round number, that now becomes a cost basis for the share class. So we know that the company is going to buy his shares for that amount of money. We know what the share price now is.
Chris,
it's provided a cost basis to the IRS. We know what all your other ones out. So again, from a tax standpoint, it can provide that to the IRS. And you guys, the company now has a cost basis, so it can lower the tax liability for everybody else. So
is that a taxable event, Chris? When someone dies and there's a buyout, is that a taxable event where the IRS looks at the cost basis and looks for a capital gain?
It's not a taxable event for the shareholders. What it becomes a taxable event for, the entity purchase is not. It's not a great deal for his beneficiary. It's not going to hurt him because you're doing it through a trust. Mm-hmm. But the problem is when you do it this way, the shares actually pass, and I'll use Eric for example, it's going to go to whoever his beneficiary was. In this point, it's going to a trust, so it's not going to hurt him. If it was going to, let's say his, I think you said you had a brother.
Right.
Who's not involved. Your brother would actually inherit those shares. There's no tax, but because the company is going to buy those shares, The company has the money, they're gonna turn and buy those shares. It's a taxable event when they buy those shares.
Okay.
Again,
Yeah.
there's no cost basis. We go back to that terminology. That's a taxable event for his brother. Because they're going into a trust, the trust is gonna pay tax. Again, it's not hurting anybody. The trust itself is gonna pay the tax
Okay.
from that standpoint. But it's not for the shareholders around the table here. So no, to answer your question, Brett, there's no tax there. Just to kind of give you guys some food for thought. This was, again, you guys are younger than this example, so it's not. Some of you guys are younger, some of you guys are not. So I'm gonna try to. Oh, that was way too big. I'm trying to make it. All right, so this is just an example. You know, IRAs, Roth IRAs, you can put in $6,500 this year. This is $6,000. This is what we did for a client. But you know, the idea of an IUL is that you buy it and you're trying to put the least amount of insurance that you can. In y'all's situation, we're probably going to do some different things. We already talked about we're probably going to try to structure these scenarios to where we're buying the amount of insurance that we need based on the percentage of ownership that you have in the company. So we're going to structure this differently. I'm really just trying to show you kind of how they work so you get kind of nuts and bolts. So in this scenario, what we're trying to do is we're using this internal workings of an insurance contract to grow value internally in the contract. So we're paying $6,000 a year, and the idea is it's going to grow tax-free inside of this vehicle. At the end of, we ran it 22 years, at the end of these 22 years, we're going to take an income off of this, and it paid about $17,000. So he put in $6,000 a year for 22 years. We paid $132,000, and it projected to pay him $17,000 a year from 65 until he was 90. So it paid him $431,000. So he put in 130 and paid him 4 times that in income. So that's what they're designed to do. So again, the more we put into it, the more it's going to pay, but it pays out about 4 times what we put into it. So that's what they're designed to do. These are vehicles that are tied to an index, a market index like the S&P 500, but they're not subject to market losses. So they go up as the market goes up, if the market goes down, they stay the same. So again,
That's huge.
but they also have a death benefit. That's the other thing. So they're going to have a value or a death benefit that, again, if something happens to one of the shareholders, the entity itself would be the beneficiary, and it pays off the other shareholder. So for you guys, you know, it can provide that death benefit that we need for the buy-sell. It also provides a retirement benefit that we talked about at the beginning. So Eric, as you said, it gives us both of those things, and it can give us a vehicle that we can borrow from, you know, as we're trying to do other real estate transactions and things of that nature down the road. You know.
So how does the borrowing work? So if we have if we paid in $100,000, we can borrow with $50,000 off of that, or how does that?
You can typically borrow. Yeah, you can borrow 85% of the values.
Oh wow.
Yeah, you can actually borrow a lot, and this may not be the contract. It depends on how quickly we want to borrow from it. There are actually other contracts we can borrow within 30 days. So it depends on how much we want to put into it and how we want to structure it. So I think that's a different conversation. I mean, here let me just show you, because again, this might be more. I don't know what we're trying to.
I'm just asking. Yeah, we got.
No. And like I said, we've got about. I don't know how much coverage we've got to buy. This is a different scenario. So again, I'm just showing you guys some different ideas. I mean, I don't know what we've got to put into it. This is one we funded a lot more, but this may give you more ideas. This was one for a client. We had to buy a lot more death benefit. We put $1.8 billion. We put $37,000 a year for 5 years, and we dropped it to $24,000. But the values were much higher. I mean, at the end of 5 years, they've got $125,000 that's built into it. You know, At the end of 10 years, they've got $270,000 roughly that they can borrow from. Lots of different scenarios within that, and we only paid it for 15 years. Again, much older clientele, so it depends on what we're trying to do.
Right.
Again, on a 30-year-old, the costs are not going to be these scenarios.
Right.
Sorry, just to clarify, the surrender.
Yeah, we've got lots of variables. Go ahead. I'm sorry.
No, it's okay. The surrender value would be the potential that we could withdraw on.
That's correct.
Okay.
The surrender value. That's correct. Yeah, and that's why I said we may not exactly use this contract. We've got a couple of contracts that, are 5-year surrender contracts that allow us to borrow a lot more value from it. So if it's something that as Eric said, we have contracts that are designed to use for that be-your-own bank model, to where we know we're going to buy more real estate. I have real estate clients that use this type product. That's what they want to use it for. It's designed in this. It's a 5-year contract. It's a 5-year surrender. It's designed to boost value in the first 5 years. So we might look at that type of a product. It may make more sense because in the first 5 years, did I lose you? Okay, sorry. In the first 5 years, that surrender charge goes away and it boosts the value up a lot faster. So it may be that we do something like that, knowing that you guys want to use it and dip into the value. So again, we may mix and match depending on some different things. I think that's it gives us a lot of flexibility to do things. I had these up because I wanted you guys to see some different functionality of that. But to Eric's point, I wanted you guys to see that these can be used for retirement vehicles and to give you guys the flexibility to say, hey, it's out there. I run our investment advisory firm, so we can also come out here and do, Roth IRAs and things of that nature. Just like Brett said at the beginning, hiring your children. You guys are self-employed and doing a Roth IRA, and doing that is a smart practice as well. It allows you to start down on your payroll and doing that. Anything that you can do earlier, the better. So again, we can talk those directions as well. This is a lot of information, it's complicated, but Brett, anything that I missed that you want me to walk through?
Do you guys understand the IUL product and how it works? I know you do, but are y'all familiar with them at all?
No.
He mentioned it a little bit, but if you could do a little bit of an overview on an IUL and how it's indexed and how it stair steps and all that kind of stuff. You hit it a little bit, but maybe a little bit more.
Yeah, I mean, so the way that I try to talk about IULs is I did talk about indexing. An IUL it's a life insurance product. So first and foremost, remember that. But we're only using the life insurance product because of the tax benefits of the life insurance itself. All right. So what we're going to try to do is build the investment inside of the life insurance, because that's one of the few investments that we can still use that allows us to grow tax-free inside of it and borrow from it tax-free.
Wow.
And the IRS does not allow us to pay taxes on it.
Wow.
The IRS codes allow us to do that. That's really the reason that we're using that vehicle. That's it.
Yeah.
Within that, we can also guarantee that we don't have any losses within that outside of cost of insurance. So at the very beginning, if you heard me say, we're going to try to keep the cost of insurance really low within that. Now, in your structure, right, we're doing a buy sell. So we're going to do some different things. We're going to make sure that we have enough to cover the structure of, the ownership structure, but we really want to keep the cost of insurance low because that's the only expense that you have within that. That's the only thing that's coming out. As far as losses, this is an insurance policy, so it's not subject to losses in the market. It indexes to an index like the S&P 500 or the Dow Jones. So as the market goes up, you're going to go up. If it goes down, you stay the same. Let me see if I can find it in here.
While you're looking for that, Chris, from my perspective, I got an IUL on my son, which the cost of insurance, I got a little bit of insurance, but I'm putting a lot of money in there, and that excess money is a savings account within the insurance product. So that's
correct.
But if you're doing a buy sell, we're gonna have a little bit higher insurance than we normally would. So you're not gonna get as much cash value in it. So it may be good to mix and match, like he's saying.
Right, okay.
So that's just why he's
Well,
looking at it.
it may be good to do both. My screen's black for some reason. Can you see?
No, we see
Oh, we
it.
can see it.
You always see it. Yep.
Okay, so if you look, so right here you can see where it says that first column is the S&P 500, and that's just the return since 2002, and it shows 17.3, 12.8, and you see a negative 39. Okay, the one right beside it is the S&P 500 with 100% or with 10% cap. So that is actually the insurance model right there. So you'll see as the insurance policy credits interest, you'll see 10% because that's the cap. That's the highest it can credit in the policy. So it'll cap out at 10%, 5.41 because that's what the model did. 10%, 1.32. That negative 39 right there in 2008, they still credited 0.25. So anytime, that's why I try to point that out. Anytime there's a negative, you're still going to get a positive 0.25. So anytime there's a negative, you still don't go backwards. That's the biggest thing within the indexing models is that you're never going to see a negative rate. So
Is
on
that
average, if you look at the 10-year average, it was 7.24. The 20-year average was 6.54. So historically, you're going to get, I would tell you, 6 to 7%, and that holds true over that 20-year return. That's the difference. So again, the only cost that we have to think about, just like Brett was saying, is cost of insurance. So if we can keep that as low as possible for you guys, there's where the returns are. We don't have to worry about negative losses. So that's the biggest thing. That's where I think the IUL makes sense from that standpoint, from a retirement plan standpoint.
Yeah.
Brett, does that help?
Very
That
much
makes
so.
sense.
Yeah, it's just a much safer way to. It's tax sheltered. It's safer because you can't lose it in the market. The market crashes, you don't lose, you still gain. I'd rather be tied into IUL than the market, especially right now with a lot of the. It's just really crazy right now out there. I'd rather have stability. That's why I like the IUL product and the annuity, the indexed annuity type products as well. Can you hit on annuities just a minute, just to educate them on what an annuity is from the insurance side, how we do it?
Yeah, and the annuity is just a savings account with an insurance company. I mean, that's really all it is. It grows tax deferred. You can use indexing the same way as we do here. Again, you're not going to have a negative from the same point of view. The difference is going to be, on the IUL side is we typically get a little bit more growth than we do on the annuity standpoint. So that's really the difference. But again, it's just a savings account with an insurance company.
And they're young. Some of them in the room are young
The
enough.
biggest thing is, from a guarantee, is we're never going to lose money with either one of them from that standpoint.
And the younger you are, the more an annuity will work for you.
The younger you are, the better off the IUL
The
will
IUL
be
as well. Okay.
for you. Yeah,
The
that's what I
annuity is
would
what we
say.
roll like IRAs into when you.
I would tend to limit.
That's awesome.
You guys have any more questions for him about that? Because I think when he finds out, you kind of know homework. You and Zach, the guys that crunch the numbers, know y'all need to look at what your goals are, and I can help y'all with that, what your goal is, and then we can go to him with some numbers.
Right.
Okay, we need this much, and we want to do
Awesome.
this kind of retirement that'll pay this kind of amount out, and then he can start crunching some illustrations for us, and I can run illustrations as well.
Now, do you have a worksheet that you can send us that you want us to fill out, or is that from something Brett can?
You want a green sheet from them?
That, or like you said, I think if you just work numbers, I could probably start working on some different ideas. I might can send, I don't know if we need to do, why don't you just work the numbers on what you guys think we might need on the buy-sell side?
Okay.
Let's start with that, and then let me work on some different ideas from that side. And then, do you guys have a different idea of what you guys have looked at, forecasted on what you guys are going to need cash, on what you guys are going to project to move forward on projects that you're looking to purchase? Have you guys looked at both?
We have one piece of property that we're getting ready to buy, and he's gonna owner finance it. Probably he'll amortize it for 30 years with a 10-year balloon. And so if we can get the money, for the 10-year by the 10-year balloon, that would be great.
Okay. Yeah, then I would share that number with me.
Okay, it's 600. It's 600,000. Yeah, it's 600,000.
But that'd be minus 10
Yeah, 550.
years,
It's 550.
so-
We're financing 550.
Okay.
But after 10 years, it's only going to be like 300.
Yeah, after 10 years it'd be whatever.
Yeah, if we can structure it that way and have that money come due, then that would be good, right? If we can build up
Do
values
you, could
where
you,
you can borrow that or take that out of the contract.
Yep.
could you real quick,
That would make a lot of sense.
explain how the surrendering part works? So like, let's say we do the 300,000 bit, and it's like we take it out of our IUL. Do we pay that back? Is it like a loan to ourselves? Is there a set rate for that? Is it a market rate, or is it just like the valuation of our entire account goes down? Or do we have to increase the amount that we pay back into the IUL to make up for it? Like, how does the actual...
So you do it a couple of different ways. So you can borrow from yourself and you can pay it back. So that's the first thing. So you can borrow it and you can pay it back. There is a set rate. The loan rate depends on when we do it. So if we do it in 10 years, it would be a preferred loan, which is a zero net loan. So they charge you 6% and they credit you 6%, which is a wash loans with 0%.
That's awesome.
Wow.
That's huge.
Yeah, so that's why I said 10 years is really a nice number from that standpoint. So that would be a wash loan provision where we wouldn't have to pay it back. Not really, you could pay it back, but at that point it's a wash loan, so you don't have to do it that way. So that's one option. The second option is if there's enough value in the contract, you could just do a straight withdrawal on it and just withdraw the money in the contract and take it out. As long as that withdrawal, as long as there's enough value in it, you just do a straight withdrawal and take it out of the contract. So
And then the total value goes down by that amount?
That's correct. Yeah, total value is now the downside of that scenario of the withdrawal is you can't put it back if we need the death benefit. So if we're at the 10-year mark, my suggestion is we look at it, we do it as a wash loan, because at that point we can always put the money back if we need the death benefit. But we would just have that conversation to figure out which is going to be most beneficial to you guys.
Does that make sense?
Again,
And
the 10-year mark is a wash loan. It doesn't really hurt you one way or the other.
And can we come up with our own terms for putting the money back in, like X amount over 5 years or something like that?
Absolutely. Yeah. There's no structure on that. If we do it prior to that, they charge you 6% in arrears, so that interest is as soon as you take it out.
Yeah.
So again,
So we pay the 6.
10 years is really when we want to do it.
Okay.
So I would say 10 years you really want to do it. Now, again, this is in the contract that we're talking about. If we use one of the other contracts, I'll show you some of this. We would want to look at it. The 5-year contract, like I said, is designed to take money out pretty much immediately. So again, there's no wash loan provision. You can take it out. They don't charge a loan on that one. So again, we can talk about some different contracts and show you some different ideas. So we would want to look at some different ideas. But if we're really structuring around this 10 years and paying this loan back, then this contract may make the most sense. So I think we just look at some different ideas.
Okay. I have a question, if I may. So if we take out money from the policy, does it continue to accrue APY at that same level as if the money was still in there, or does that drop?
It does. So that's the advantage of doing a loan. They assume the money is still in there.
Okay.
Wow.
So when you do it as a loan, that money that you borrowed from it, the company assumes that it's still in the contract. So each year when they're crediting interest, they still credit interest that money is still in there. So for example, if there's $100,000 in the value and you took out 20, they still assume that $100,000 is in there, and that $20,000 still assumes interest. So even though they're charging you 6%, if the contract got 7, you actually had a positive 1% loan rate. So again, that's the reason that you borrow from the contract as opposed to doing a withdrawal.
Yeah, that's a no-brainer. Yeah.
Right. So that's the other
Yeah,
reason why
I have one.
we tell you don't do a withdrawal.
I have one other deeper question, and maybe you have an answer for it. But so we have the IUL through a larger company that holds lots of IULs. They index all the money onto the market, so it's indexed like that. We gain based on the index's valuation, but then it takes a hit. And correct me if I'm wrong, but the company that has all the IULs, they do take a hit on the back end, but we're somehow protected. Are we protected through another? Like, does the overall company have an insurance on the indexed fund itself, and then that insurance company protects the overall indexed fund? Or does the company just take the hit under the assumption that it has enough clients with IULs on it to fund the overall operations of everything to protect all of the IULs? Like, you see what I'm getting at? Like, you have money on
How can they afford to do it?
yeah.
So, well, we're getting inside the hot dog, but I'll be glad to tell you how.
The only thing I'm concerned about is, like, what if the hot dog slips out of the bun?
So what they do.
That's how she gets pregnant.
Is, to answer your question, yes, most companies buy reinsurance, especially on large contracts.
Cool, that's good. I'm good.
They do buy reinsurance, but they are not taking the risk themselves.
Mm-hmm.
They're not saying, okay, on your $1 million or you're putting into it, we're not going to let you go out and say we're going to put all this in the market and assume the market's going to return all this, because they don't take risk either.
Mm-hmm.
What they do is they buy options on the market.
Mm-hmm.
So they buy an option that says, hey, if the market is positive, they buy an option that gives you your return. I showed that screen that said, hey, the market goes up 15, you get 10. Mm-hmm. They buy an option that says if you get 10, they're going to give you 10, they're going to make 12, right? Because that's their profit.
Mm-hmm.
That's where they make money.
Mm-hmm.
They also turn around and buy options on the market if the market's negative.
Mm-hmm.
They buy an option that gives you 0.25 because that's what the guaranteed rate is. So they buy 2 options each year on the money that you put into the contract. Mm-hmm. They buy an option that guarantees that they don't lose money,
Mm-hmm.
and they buy an option that if the market is positive, that they give you the 10% that they guarantee to give you,
Mm-hmm.
and they buy a little bit more than that so that they're profitable.
Mm-hmm.
And to the other point that you made, yes, they do that on 1,000 people, not just one person. So law of large numbers plays a factor.
Mm-hmm.
But that's what they do. They're buying options. They're not just playing with your money and just putting it on red. They're buying options.
And the fact that they have a cap,
That's what they do.
the fact that they have a cap that if the market goes up 16 points, you only get 10. That's where you're paying for it too. But that's what you pay for the benefit of never losing, which is
That's correct. That's correct. Yeah. And clients ask me all the time, well, they're keeping all that difference. No, they're not. They're buying options.
Mm-hmm.
That's where they make their money, is they buy options, and they're very, very good at it. So they're insurance companies. They make. I mean, I make no bones about it that they're a for-profit industry, and they've been around a long time. So they they're good at it. And as you said, it's the law of large numbers. They do it on 1,000 people, not just one person. So, but that's what they do. But they do buy reinsurance, and they spread their risk out.
Cool.
So absolutely, they're not taking that risk.
Awesome.
But that's a great question.
Thank you.
Yeah, I'm good.
Yeah, we're good. All right.
Okay.
Thanks, Chris.
So if you want to give me numbers, I'll start working with some ideas.
Okay, we'll get
sounds
them to you.
great. Thank you, sir. Appreciate
Thanks,
your
Chris.
time.
Thank you, man.
Take care, buddy.
Appreciate that
Have a
very
good
much.
week.
Thank you.